tradingforbeginners.fx, and I remain your host, Mr. Babs. So today I literally want to talk about Forex made simple, and this is actually going to be a beginner's cheat sheet guide for anyone who wants to start their Forex trading journey and literally don't know where to begin. So yeah, without wasting too much of our time, by the end of this video you should be able to literally differentiate a whole lot of things as a forex trader or as a beginner forex trader. So yeah, what are we going to learn in this class? You're going to learn what is forex trading and how it works. You're going to learn the key terms every beginner must know. You're going to learn the role of currency pairs, pips, and lot size. You're going to learn how to read simple candlestick charts and patterns. You're going to get a step-by-step guide to placing your first trade. And also, you're going to get proven beginner strategies to avoid costly mistakes. There's a typo there. Now, what is forex trading? Trading is literally gotten from the word foreign exchange, and simply put, it is the buying and selling of two currency pairs of two different countries simultaneously. It is the largest financial market traded in the world with a daily liquidity of around $7 trillion, and I think the numbers are going higher by the day. Now, the forex market opens every Sunday at 10 p.m. GMT and closes at 10 p.m. GMT on Fridays. It is open 24 hours 5 days a week, and of course there are other financial instruments which are also tradable, but for starters I would be sticking with forex, or I advise you to start with forex. Of course you can start with any other trading pair, but it's easy to actually sharpen your skill as a forex trader before going on to trade other volatile pairs. Now, how does it work? There are different types of forex trading, and over the years, the first one is we have scalping. Scalping are literally people that catch small moves in the market. They literally just trade between maybe 20 pips to 50 pips max, and most times their trading time frame is literally on the 5 minutes, 15 minutes, and maybe at most 1 hour at most, which is on rare occasions. Yeah, we have the day trading. These are people that trade within the 24-hour day or within the 8 hours active trading time, so they don't leave their trades till the next day. We also have swing trading. These are people that catch long swings, like you can see here. For someone who literally entered at this support zone, would literally, or demand zone, would literally catch all the way down to this point. That's a swing, the whole long movement. And then there are position traders, or there is position trading. These are people that trade um the market based on the position they literally feel like they want to be on, the bias they want to be on. And yeah, now how does it work? Types of forex trading analysis. There are different types of forex trading analysis. The first one is fundamental analysis. Now, what is fundamental analysis? Fundamental analysis is basically you analyzing the chart based on the news. Now, there are different websites that literally tells us or gives us information about what the foreign exchange market is about, or what's to expect, what the news, the intricacies, the ups and downs, are about a particular currency or about a particular economy. Now, we also have technical analysis. These are people who literally analyze the chart from the technical aspect. As we talk about things like candlesticks, chart patterns, moving averages, indicators, price action, support and resistance, demand and supply. They literally combine multiple factors together to give them a general overview of what the price or the chart is doing at that particular time. And there is sentimental analysis. Some people trade based on sentimental analysis. And what does this mean? What this literally basically means is you are trading the market based on your emotional connect. That's based on maybe a recommendation from somebody, or maybe a bias from somebody, or maybe the general public bias, and you're going with the crowd, you're going with what people feel, rather than you paying rapt attention to what the chart or the market is basically showing you. Now, the basic terms in forex trading. Yeah, forex trading sessions. We have about four of them. We have the Sydney session. It runs from 10 p.m. GMT to 6 a.m. GMT. We have the Tokyo session, which is 12 a.m. to 8 a.m. GMT. We have the London session, which is 8 a.m. to 4 p.m. GMT, and we also have the New York session, which is 1 p.m. to 9 p.m. GMT. Now, if you look at the right, you can see a simple chart illustration showing you the different sessions and how they run. Now, as these sessions unfold in the forex market, they tend to interact with one another. Now, what do I mean by that? That means sometimes before one session is over, the next session begins. So you kind of have like an overlap of two sessions being active at the same time. Now, because of this concept, it gives you room for what we call the most trade active trading hours. And when is that? That is mostly when the London session overlaps the New York session, and I think about 4 hours of that session overlap, you tend to find the market literally give you huge volumes and huge momentum movement, because actually the London, which is the GBP, and the New York, which is USD, which happen to be two of the most traded currencies in the financial market. They are active, their economy is active at that point in time. So most traders, some traders, especially day traders, tend to focus on trying to trade this session overlap, where they have London over the New York, and oftentimes this is mostly between around 1 p.m. GMT and 4 p.m. GMT. And now the beautiful thing is, if you follow this path, you are sure to get more reward around that particular time. Yeah, moving on, we have basic terms in forex trading. Now, what are major trading currencies? Now, the major currencies in the financial market as a forex trader, we have the USD, we have the GBP, we have the Euro, we have the CAD, we have the CHF, we have the AUD, we have the NZD, and we have the JPY. Now, USD is United States dollar, CHF is Swiss francs, GBP is Great British pound, AUD is Australian dollar, Euros is Euro, NZD is New Zealand dollar, CAD is Canadian dollar, and JPY is Japanese yen. Now, these are the most traded currencies in the forex market. As such, their spreads are always lower. Now, when currencies are not actively being traded, you get to find out that they have higher spreads. Now, what are spreads? I'll talk about them in furthermore in this class. Is literally the difference between the buy and the ask price, bid and the ask price, and most times the brokers or the market makers tend to make their money off your spread. So the difference between how much they sell to you and how much they buy from you, or how much you buy from them and how much you sell to them, is your spread, and that is where they make their money. So actively traded pairs literally have less spread compared to low volume traded pairs. Now, these major currencies combined together gives us the major trading pairs in the forex market. Now, what are the major trading pairs or the major currency pairs? Of course, they are, as a currency is single, but then when you pair them against another currency, they become the pairs. Now, these eight major currencies form the seven most traded active currency pairs in the forex market. And what are those pairs? We have the Euro USD, we have the GBP USD, we have the NZD USD, we have the USD CAD, we have the USD JPY, and we have the AUD USD, and we have the USD CHF. Also, now, another basic term in forex trading that everybody wants to know or understand is what I call the base and quote currency. Now, using the Euro USD as an example, the first one on the left, which is Euro, is my base currency, and the next pair on the right is my quote currency. Now, the same is goes for every currency pair. Once you see two currency paired together, the one on the left is the base currency, the one on the right is the quote currency. So what this significantly means is you're trading the quote currency in respect to the base currency. Now, for instance, if I decide to buy Euro USD, what I am speculating is the Euro is going to be stronger than the USD, and the USD will be weaker at that particular time. And then if I sell, the euro would be is going to be weak and the USD will be stronger at that particular time. Now, using numbers to illustrate further, what this means is 1 unit of the quote base currency is going to be uh more of the quote currency. Now that means, for instance, the value of 1 unit of base currency, which is euro, is in this case 1 euro will be equals to 1.4 USD. So I need 1 USD and 40 cents, 1 USD and 40 cents here to make up 1 euro per euro currency based on the conversion rate. Now, we also have what we call the cross currency. Now, what are cross currency? These are currency pairs that do not contain the USD. Now, if you notice the first set of major currency pairs, they all have USD within them. Now, USD is literally the most traded currency in the whole world, and yeah, most of every other pair is literally traded against the United States dollar because of the strength of the currency and economy. And these are currency pairs, the cross currency now. These are currency pairs that do not contain the USD. The most actively traded crosses are derived from the three major non-USD currencies. Now, what are the three major non-USD currencies? We have the euro, we have the GBP, and we have the Japanese yen. Now, this currency, cross currency, put together forms the cross currency pairs. Of course, you can't trade a single currency, but then you trade them in pairs, one against the other, the base against the quotes. So, yeah, the cross currency pairs, we have the Euro CHF, we have Euro GBP, we have Euro CAD, we have Euro AUD, we have Euro NZD, we have GBP CAD, we have GBP AUD, we have Euro JPY, we have GBP JPY, we have CHF JPY, we have CAD JPY, we have NZD JPY, we have GBP NZD, and we have GBP CHF, which is Swiss franc. All right, moving on, we have other crosses in under the basics in forex trading. The other crosses, these pairs are not as heavily traded as the major currencies or the crosses. So the spreads charged on these pairs are usually very huge. So compared to the major currency pairs, which I talked about a bit earlier, this set of currency pairs are, they have higher spreads, and the spread, like I said, which I'm still going to talk about, is the difference between your bid and ask price. Yeah. Now, example of those other crosses, we have the Australian dollar, Canadian dollar, AUD card. We have New Zealand dollar, Canadian dollar, NZD card. We have AUD, NZD. We have CAD, CHF. We have USD, MXN. Yeah, CAD, CHF. Now, we have the exotic pairs. Now, the exotic pairs are literally, virtually, they are traded as well, but most people tend to stay away from them because they literally don't have significant movements, and they hardly give you volatile profits within the trading day. So now those pairs are USD MXN, Mexican pesos. We have USD ZAR, USD SGD. We have GBP CAD. Now, moving on, we have major participants in the market. Now, who are the major participants in the market? Who are those that influence the market within that period of time? Now, the first one is we have the interbanks. These are literally the likes of Wells Fargo, Chase, credit union banks, and all the literally private commercially owned banks. We also have the large commercial banks here, the likes of JP Morgan Chase, and people like that. And we also have government and central banks. Of course, the government also trades forex because they have to exchange a bit of their own currency with a bit of other foreign currencies in order to enable foreign exchange for businesses and companies and things like that. So yes, there's a never ending constant, you know, um currency exchanging hands in the economic space, as the banks and the governments literally have to keep trade going. So yes, there will always be a need for a demand of foreign currencies as opposed to your home currency. Now, the reason why forex is good is because forex opens you up to trading all of these different currency pairs without physically or actively going to that country or that location. So you can literally trade or you can literally make money off the interchanging of currency pairs of one country against the other, just from the comfort of wherever you are with your laptop, your internet, and your analysis knowledge. Now we have the speculators. Who are the speculators? Speculators are basically me and you who literally don't move the market, but then we can make money from the market. So speculators are little traders, your $100, $1,000, $10,000, and maybe 100K sometimes. Because yeah, 100K, I'll still say you are still a speculator, because there are people who trade millions of dollar, and I repeat, millions of dollar every blessed day. So yeah, we are the speculators, and we literally don't have much impact or effect on the market. Now we have moving on basics, still on basic terms in forex trading. We have the bulls and the bears. Now a lot of you must have heard people say things like, "Oh, I'm bullish," "Oh, I'm bearish," "Oh yeah, bulls," "Oh yeah, bear." Now the thing is, if you pay attention closely, this term is gotten metaphorically from a bull and a bear. Now, my own interpretation is this for clearer understanding. When a bull wants to attack you, it comes from down and takes you up. And when a bear wants to attack you, it comes from up and bring you down. Now, the bull signifies bullish trend as buying markets. A trader taking a bullish position can be said to be long. Now, the bear signifies bearish trends or selling market, and a trader taking a bearish position can be said to be short. Now, having said that, this gives us the concept that where we talk about bullish long buy position or bearish short sell position. Now, what do I mean by bullish long buy position? Now, it's either if I say I'm bullish, it's the same thing as I am long, or it is the same thing as I am buying a particular position. Excuse me, please. Now, when you say you are in a bullish trend or you are long on a particular pair, what that means is you're literally in an uptrend, seeing higher highs and higher lows, which of course that's a concept or a characteristics of trend analysis, which I talk about in a more in-depth video, not this. Now, when I say I'm bullish, it means I am buying that particular pair. I am looking at taking that particular pair from whatsoever price it is currently to a higher price that I am looking to aim for, a higher price that I am looking to target. So I'm expecting the price to go from whatever price it is currently to higher prices. That's I'm bullish, that's I'm long, that's I'm buying that position. Now the flip side of it is the bearish version, which is if I say I'm bearish or I am shorting or I'm selling a particular position, what this means is I am in a bearish trend, and as such I would have more of lower prices. So price goes from a particular price to a lower price and to even lower prices. So it fluctuates between, as it tries to pull back, then it drops lower, it pulls back, it drops lower. So bearish version is I'm literally going from higher prices to lower prices. I'm looking to sell or to short from whatever it is I am currently to a lower price. And now the beauty about it is this: for every trend, there is the impulsive move and there's the corrective move. Now, on the bullish trend, for instance, the impulsive moves is the green candles or the white candles, whatever color. This is color relative, it's not fixed. You can have your MetaTrader or your trading app use different colors, but now you just have to know the bullish and bearish version based on the open and close of the candles, which I will talk about in candlestick videos. Now, for every bullish trend, there's the impulsive move, which is the longest leg of the move, and then there's the correction wave, which is a pullback, and then of course for that trend to continue in that same direction, I have to see another impulsive move, another correction, another impulsive move, and as long as I keep seeing impulse and correction, more impulse, less correction, that means I am in a bullish trend. Now, if I come to a bearish trend, the same is literally the case, is just flipped upside down. So now for a bearish trend or for a sell trade, I am looking at my impulse move, which is a down swing, to be longer than the pullback, which is a correction, another impulse as long as I am in a downtrend, and then pullback, which is correction. Furthermore, that way as we go up down till we get to wherever it is we're targeting. And yeah, Now, moving on, what else do we have here? We have bid and ask price. Now, what is bid and ask price? The bid and ask price, if you look at your price reading at any point in time, like I have on the right here, we have GBP USD. You'll see two prices. The first one on the left and the first one on the right. Now, initially when I talked about base and quote currencies, the one on the left was your base currency, the one on your right is your quote currency. Now, the bid and ask price is basically the price at which you can buy an asset from the market. That's the ask price. Now, the ask price is the amount the broker is willing to sell to you. So if you place an order, you're buying at the broker's ask price. And if you decide to sell, it's the price at which the broker will buy from you. So if you notice, just like every trade or every commodity, you want to make profits, right? Now, the crazy thing about trying to make profits is this. Um, you can't sell at the exact price you bought, because if the broker, now which is the market maker, if they sell at the same price they bought, they would not make any profit. So here's what they do: they have to buy at a lower price, maybe 2 pips, 3 pips, 5 pips different, and sell at a higher price. So that way, the difference between how much they bought from you and how much they are selling back to you or to other traders gives them their profit. Now, also flip side, they have to buy from you at a lower price and sell at a higher price in order to make profit. So this gives us the concept of the bid price and the ask price. So the bid price is the price you are going to buy from the market, and yeah, bid price is the price you are going to sell to the market. That's the market's demand price. And then the ask price is the price the market is selling to you. So for the market to sell to you, they have a price that they are willing for you to pay. So now, speaking of bid and ask price, it gives us the concept of what we call spread. So you can see here we have bid to ask spread. Now, what is the bid to ask spread? The bid to ask spread is basically the difference between the ask price and the bid price. Now, this is the difference between how much the market is selling to buyers and how much the market is buying from sellers. So the difference is the spread, and that is also one way most brokers, which are also called market makers, make their money. Now, moving on, the bid and ask spread. Yes, spread is the difference between the ask price and the bid price. And price takers, you buy at the ask price and sell at the bid price. That we are the price takers. Whatsoever they offer us is what we have to take. The only way we can say no is if we don't want to open that position. But as long as you're trying to open that position, trust me, you would want to and have to and need to and must take the price that the broker is offering. Now we have the market makers, which are the brokers. Now the brokers buy at the bid price and sell at the ask price. So now the flip is the case for them. They are buying at the bid price and then selling to us at the ask price, while we are buying at the ask price and selling to them at the bid price. So now, if you notice, your bid price will always be lower than your ask price. So we deal at the ask price. That's the price we are buying the market, and yes, they deal at the the bid price. That's the price we are willing to sell. They are willing to take for that particular commodity. Now, the difference between the two, like I said earlier, is what we call the spread, and of course, brokers make their money off that. Now, we have market orders, instant execution orders. Now, there are two types of market orders. The first one is instant execution. This involves buying and selling at a fixed current price. Now, when you buy and sell uh, any pair, that price which you open exactly is instant execution order. You buy instantly, you sell instantly, and then immediately you open, it triggers. But now, for some reason, let's say over the years, I guess brokers and the market had discovered that for some reason, there are a lot of reasons why someone might not be at their chart at a particular time, or maybe they don't want to be patiently wait till when it gets to where they are looking at before opening their position. So what did they do? They created what we call the pending market order. Now, the pending market order tends to give you opportunity to set a pending price or position in the future and then open or execute that trade once price gets to that area. Now, here's what we find out. We have market this involves setting a pending order, buy or sell at the future price with a particular expectation in mind. Now, the pending market orders that are most used or most common or most paid attention to are four. We have the buy stop, we have the buy limit, we have the sell stop, and we have the sell limit. Now, the buy stop is order placed above price and price keeps going up. So what does that mean? That means, let's say price has been coming from a downtrend, and then at some point it gets to an area that we feel like, okay, from this point onward this price is going to keep going up. So what do? I set a buy stop above where price is currently, saying that as long as you hit this area you should continue going higher. Now I'll set my stop loss below the zone and then my take profit ahead, looking to continue that uptrend in that direction. Now we have a buy limit. A buy limit is literally like opposite of buy stop, but then it's tricky in the sense that buy limit is an order placed below price and then price goes up. So now let's say we are in an uptrend, for instance, and then I see a pullback and I am expecting that, okay, that pullback should not be too deep. The moment it gets to this particular area, there should be a correction and price should now continue going higher because I am in an uptrend, for instance. So that means what I am doing is I am setting a buy limit below the current price, that okay, for whatsoever price decides to do, it should not go below this particular area, and immediately it gets to this area there should be a reaction and then I should start going back in the original direction. Now, coming to the sell side, we have the sell stop and the sell limit. Now, for the sell stop, this is literally flip side of buy stop. It says order is placed below price and price keeps going down. So what this means is I literally set my order. Maybe I'm in a downtrend, for instance, and I have seen a lower high, and then I am like, okay, from this lower high there's a rejection. So as long as we are rejecting this area and continuing downward, we should keep going down for quite some time. So what do? I'll set a sell stop below the current price movement somewhere here and say, okay, the moment you hit that zone, I am expecting you to continue dropping. So what would I do? I'll set my stop loss above my entry and then my targets way below, looking to take the trend downwards. And then the flip side of the buy limit is the sell limit. So let's say I am in a downtrend. I have done the first leg of movement and now I notice a correction wave. And at some point, I discover or identify the area that I expect price should not break above for this trend to continue higher. So what do I do? What I would do is this. I would set a sell limit that, okay, for every rejection, as you are pulling back, don't go above this zone. The moment you get to this area, open a position for me and I expect you to reverse and sell. Now, of course, you don't want to open trades without setting your take profit and stop loss, which I'll talk about um, a little bit shortly. But now, for every trade you are opening, you always want to have your stop loss, at least, even if you don't have your take profit, because the market can be funny, the market can be volatile, there could be news, there could be anything or any reason why market can decide to trick you out before it continues going your direction. So yeah, moving on, we have lot size. Now lot size, how do I put this? Okay, lot size is basically the capacity to risk as much as it's the capacity to reward. Now it is the size or position of your trade at a particular time. There are different types of lot sizes, and the major ones we pay attention to is standard lot size, mini lot size, excuse me, and micro lot size. Now, standard lot size is in units of 100,000. The volume is 1.0, and then what this means is for every pip movement, every small jump in price, one pip is $10. So if price moves $100, that's 10. If price moves 100 pips, that's $10 times 100. That's about $1,000. So the same movement, the same analysis, mini lot size. Now, mini lot size, the unit of that price is 10,000. The volume of trade open is 0.1. And then what that means is for every pip movement in the mini lot size, one pip is $1. So if price moves $100, so I would have $100. If price move 100 pips, that means I would have $1 times 100 pips, which is $100 value. Micro lot size, which a lot of us or beginners pay attention to, Then as more as your capacity and your portfolio grows, you can now start doing 0.1 and maybe 1.0 at some point, depending on how much you have. Now the micro lot size is a unit of 1000. You open 0.01, and then the dollar is 10 cents per pip. Yeah, so that $100 will be, that 100 pips now will be $10. Now nano lot size, a lot of people use this. Most times this is when you open excuse me, this is when you open a cent account. Now, if you are trading a cent account most times, which is not very common, that's when you use the nano lot size, and then you use lot size like 0.001, and yeah, for that it is 1 cent per pip. So now the whole of 100 pip will just be $10. So you see the difference. Now the trick about lot size is this. Let's assume you analyze Euro USD at, and then the ask price is 1.132. Someone who opens a one lot size needs a unit of $113,000. Now, if that price moves in profit or loss, they would also be risking in that same capacity. Now, someone who uses a zero point 0.1 lot size would use 11.322. That's $11,300. Now, the same movement, nothing changed, just the risk to the reward, which is their lot size. And now that person is making $11,000. And then someone who uses 0.01 would make $1,300. Same movement, same analysis, nothing changed, just the lot size. Now, the same way you have the capacity to make more using a higher lot size, that's the same way you have the capacity to lose more using a higher lot size. So it's not advisable for you to exhaust your lot size because you can, or because you have the balance, because one flip movement can literally wipe out your account and then bring you back to zero. So I hope you pay attention to that. Now, other terms that you want to pay attention as a beginner forex trader is what we call leverage. The first one here is leverage. Now, what is leverage? Leverage is the downside capital your broker borrows you to help you open trades larger than your account size. So now, when you have leverage, it's like, okay, yes, you have $10 and you want to trade a $1,000 pair, then I would give you the remaining $9,000 in visual, in their mind. Now it's physical, yeah, but it's in visual, because here's what happens. If for any reason you go below your own balance, they close you out. So nothing happens to their leverage. At every time, the broker protects their leverage. So you can only risk your own money against their support, against their leverage, but you can never truly risk their leverage. That's why when people say, oh yeah, I have a leverage that is quite large, you can't use up that leverage. If you open any size that is larger than your trade, the moment your balance is being exhausted and price sees maybe it continues to take you in a loss, what you find out will happen is what we call margin call. A margin call is your broker closing every open trade and then giving you back your profit or your loss while they take their leverage from you. So they don't want to lose their own money. But if you are sure about what you're doing, they are willing to give you money in advance to make more money. So that's the trick about leverage. So sometimes you cannot completely use up your leverage regardless of how much leverage you have access to. Now, also we have equity. Equity refers to your total balance plus or minus your profit or loss. Now, let's say my balance is $1,000 like I have here, and then for some reason I took a trade and I am in current profit of $100. That means my equity is going to be $1,100. Now, if I am in a loss of $100, that means my equity will be $900. My 1,000 balance minus my $100. That's for equity. So I hope this makes sense. Also, we have a margin. Margin, just like I talked about margin call, is your initial risk from your account when you subtract your broker's leverage. So your broker, yes, can give you leverage to open bigger trades, but the moment they see that you're trying to lose more than what you yourself have as a balance, they'll do a margin call on you and then take back their leverage and leave you with your loss. So sometimes, even with your margin, you still have to be careful how you risk on your trades. Also, we have pips. Now, pips are small movements or simple movements of the market per unit price. It is the fourth digital number after the decimal point. Now, pips in forex trading, percentage in profit, that's what pips mean. And now, for example, we have two categories of price movements in forex. Now, for the euro USD, we have four decimal place price number. That's 1.2345. Now the pip starts from the last digit, and then when you go to the second digit, it becomes tens of pips. The third digit becomes hundreds of pips. The fourth digit becomes thousands of pips. So for as that number changes, as that number changes, increases or decreases, you're either in profit pips or you're in loss of pips. Now, the Euro USD and other pairs are in that structure except for every Japanese yen pair. Now the Japanese yen pair are not in 4 decimals. Instead, they are in 2 decimal places. Now because they are in 2 decimal places, it comes with a different reading. So now you're reading 2 decimal place as opposed to the 4 decimal place for other pairs like Euro USD. So now USD JPY, what do? We have 123.45. So I start counting my pips from the second digit. If I go to the next digit, it becomes 10 pips, the next one becomes 100 pips, and that way continuously it keeps going. Now, yeah, we want to talk about another very important concept in Forex, which is take profit and stop loss. Now, for every trade I open, if I am in a buy trade, for instance, first of all, what is take profit? Take profit is a pending order you set on your trade if the price movement goes in your favor. Now, stop loss is a pending order you set on your trade in any case the price goes against you. Now, so let's say I am buying a particular trade, my stop loss will definitely be below my price because I am saying for a buy trade, I am expected to keep going higher. So if for any reason price goes against me and goes below my area, then of course my stop loss should trigger. That means that is the maximum loss I can take on that particular pair, on that particular position, or on that particular trade. So I don't want my loss to exceed that particular amount I have set. Now the flip side is the same for a sell trade. So if I'm selling, of course I'm looking to go to a lower prices, right? I'm looking to buy at a higher price, I'm looking to sell at a higher price, and then close at a lower price. So what happens is this: for a sell trade, I am literally going to set my stop loss above the price. So I am expecting a downtrend, price to continue coming down. So for any reason, if price decides to go against me and go back into the highs, then I am expecting that trade to close out and then sell, and take my loss, or and close me out on that trade. That's the maximum loss I can take on that particular trade. Now, how to read candlesticks. I've spoken about a whole lot of the basics of forex trading, but now just a brief one: how to read candlesticks. This is not an in-depth video of candlesticks. It's just a brief crash course of beginner concept. As a beginner, if you watch this video, I'm sure you get familiar with a whole lot of concepts. Feel free to watch it over and over again. And in case you've not liked and subscribed to my channel, this is Wealth FX Trading Made Easy. I am your host, Mr. Babs. I look forward to seeing you. Keep subscribing, keep liking, and keep sharing. So yeah, how to read candlesticks. Now candlesticks are bar representations of price movement over a certain period of time. Now for every candlesticks, we have four significant points to pay attention to. We have the open of price, we have the close of price, we have the high, and we have the low. Now the high and the low oftentimes form what we call candlestick wicks. Now you notice those long tails either above a candle or below a candle. Most times those tails signifies direction of rejection of prices. So as much as the candle, we use candle because the body tells us a whole lot of information, but then the wick still also tells us more, and then the tails, the rejection, tells us a whole lot as well. Now candlesticks, of course, we have the bearish and the bullish version, which I'm going to be talking about shortly. Now, there are two major categories of candlesticks. We have the directional candlesticks, and then we have the numerical candlesticks. Now, what do I mean by directional candlesticks? Directional candlesticks, before I go, okay, directional candlesticks are majorly, either bullish or bearish. Now, bullish is, of course, change in higher prices, price going from a lower price to a higher price, and then numerical candlesticks is single, double, and triple, which I'm going to be talking about shortly. Now, how do we read candlesticks? Now, candlesticks tells us a whole lot of information. That's why most over the years traders have focused on improving their trade and skill across understanding how to read candlesticks better. Now, what are the functions of candlesticks? Candlesticks tells you the sentiment of the market, it tells you the strength of the trend, it tells you reversal points, it tells you retracement, it tells you entries and exits as well. You can use candlesticks to to magnify and to amplify and to improve your results. Now, Speaking of candlesticks, this is a candlestick chart, candlestick strength chart. And now the bullish version is this. We have what we call the Marubozu. The Marubozu is no wick to the up and down side. It signifies a whole lot of strength. So when you see a Marubozu forming, no wick to either side, it tells you that yes, there's a whole lot of strength in the market. Of course, I tell people it's not about what you see, it is about where you see it. Also, moving on, we have the hammer. The hammer is like, yeah, you know the way your hammer looks, the long tail and then the head which you use in nailing. Yeah, that kind of structure. Now we have the inverted hammer. The inverted hammer is, this tells you that okay, price is literally going from strong trend to kind of a slow down. So you are noticing that okay, price is trying to buy quite alright, but then it is rejecting a higher prices. Now we have the spinning top. Spinning top is almost equal highs and equal lows, and then there is literally a body at the center. Then we have a doji which I have talked about in my previous classes. Doji is literally an indecision candle. Now notice how we are shifting from strength of bullish trends to weaker trends. Now after the doji, I have the dragonfly doji. Now what this tells me is yes, all of these are bullish candlesticks, but then their strength keeps dropping as we go across the chart. Now, the same goes for the bearish candle. We have the bearish Marubozu. Now, the opposite of the hammer is the shooting star, flips upside down. The opposite of the inverted hammer is the hanging man, flipped upside down. All of this signifies change in strength and the bearishness or bullishness of that particular chart. So the more I go across from left to right, the more there's a drop in price strength. Now we have the spinning top, which is the opposite of the spinning top. That's a bearish spinning top, the opposite of the spinning top. We have the doji, yes, which is almost the same thing. It's just a different color or flipped version. And then, yes, the bearish version tells me they are rejection. Now, most times the doji signifies indecision. There are different types of doji, which I talked about in my candlestick classes, but not because of, I'm not gonna, expatiate in this class because this is a crash course. Now, yeah, we have the gravestone doji. So the opposite of the dragonfly doji is the gravestone doji, and it signifies a drop or a reduce in strength of candlesticks across this medium. So yeah, all of these candlesticks, you can pay attention to them, you can use them, understand them, analyze them, and it keeps getting better. Yeah, how to read candlesticks. Now, like I said earlier, we have the bullish and the bearish version of candlesticks because they are directional candlesticks. And just like the chart I just showed you, you can predict the direction of movement using the candlestick strength. Now we have the numerical candlesticks, which is single, double, and triple. Now for the single candlestick pattern, we have the hammer, we have the inverted hammer, which is flips upside down, we have the hanging man, and we have the shooting star. Now going to the double candlesticks, we have the bullish engulfing, we have the bearish engulfing, we have the tweezer bottoms and the tweezer tops. Now going to the triple candlesticks, we have the morning star and we have the evening star, and we also have the three white soldiers and the three black crows. Now all of these have characteristics and interpretation. This is not a course to literally make you a pro. No, this is a course to get you familiar with the things you can pay attention to, the things you can learn, the things you can understand. And I'm sure if you have an in-depth knowledge of some of these concepts, it will improve your journey as a forex trader. In short, if you can watch this video to the end, I can guarantee you that you can kickstart your forex trading journey as a complete beginner. All right, we have how to start trading forex. Now, before I touch this per se, I have WhatFX has our free Telegram channel. We have our free WhatsApp discussion group, and of course, after watching this course, in case you needed any further guide or further assistance or mentorship, yes, you can feel free to reach us on our Telegram channel or on our WhatsApp discussion group, and we'll guide you and onboard you onto our VIP mentorship, where we're going to show you in-depth approach, strategies, studies, concept, knowledge, and information to help you become a better forex trader. Now, how to start trading forex market? First thing is you want to open an account with a broker. Now, yeah, there are a whole lot of brokers out there, but at FX we use Our registered brokers is the first one is FBS. I use FBS. I also add a link to that in the description of this video in case you wanted to create your your forex trading account. Now, after you've created an account with a broker, excuse me, you want to download your MT5 or MT4. I use MT5, my people use MT5, and then you log in your broker account on that MT5. Now you pick a pair, analyze the chart for possible entry, set your lot size, your stop loss, and your take profit, and boom, that's your first trade. But now here's the trick about it. There's a whole lot we analyze on the chart before we take entries, which we talk about in our in-depth classes and subsequent videos and lectures. So the trick about it is this: only watching this video will not make you a profitable trader, but it can start your journey for you from wherever you are to getting you to being a profitable trader. I did this crash course because I don't want to keep having people that don't have access to mentorship, but then they want to kickstart their forex trading journey. This course is actually like a starter pack for them, so that yes, by the time you finish this course, you are familiar with a whole lot of concepts we talk about. Then you can decide, okay, I want to now go to the next level. I want to navigate better. I want to do this. I want to do that. And yes, WealthFX is always here to guide you, to lead you, to teach you, to show you, to help you, and of course, to inspire you to become a better trader. Now you can setting your stop loss. Of course, I advise when you want to take your first trade, it is best you do it on a demo account. Now demo is like simulated amount of money where you can practice without any extras. You practice, you understand, you get familiar, and then after that you can now decide, oh, all right, this is what I want to do next, this is how I want to do it next, and things like that. So yeah, the demo just shows you how the real market operates. Everything that happens in the real market, you can literally see it on your demo. Okay, with that said, what are the trading tips to avoid costly mistakes? Yeah, tips to get ahead as a beginner. Well, as a beginner, I literally had to learn a whole lot myself. I literally had to teach, self-tutor, and literally had to, dig deep, research, watch videos, read books, read websites, take online courses, and a whole lot just to get me to where I am, which is why I am crashing the time and the knowledge base into a fast track approach to help you get to where you need to be. So rather than have you go through all what me and a whole lot of other forex traders went through, beating around the bush, trying to see what works and what doesn't work, trying to juggle between, okay, making the right choices and the right steps and the right mistakes and all of that, rather than having to go through all of that, the aim of WellFX is to help you simplify that journey as much as possible. Now, what are the trading tips to avoid, or tips to help you get ahead as a beginner? Of course, first of all, practice with a demo account. You don't want to just start, or maybe you finish watching this video and then you go deposit into your live account and start trading. I can bet you, even if you deposit $1 million, you're definitely going to blow it up. And I'm speaking from, excuse me, I'm speaking from experience. Also, you want to always set stop loss before opening entry. Never should you open a trade without setting stop loss, because what if you open the trade and for some reason the network tweaks you off, and before you come back, price goes against you so badly that you cannot recover? Yes, that's why you want to always set stop loss before opening entry. Also, very important, you want to keep learning. Forex is not a get rich quick scheme. As well, it is not a one-day journey. It's a never-ending learning process. In short, I keep learning as much as I know, or as much as, yes, I teach. I learn a whole lot more than I even practice, because every day things happen, unfold differently. There are different circumstances in the market, there are different situations in the market, things happen in different dimensions, and yes, it is easy for you to get complacent and just dwell on the knowledge of information. No, you have to keep tweaking, adjusting, improving, implementing until it gets better. Also, this is one thing you want to do, and you want to make sure you do and do really well. And what is that? You want to join WealthFX mentorship. Trust me, you need a mentor. In short, if I had a mentor, which I could not afford in the days of my forex trading, now I do. But then in the early days of my forex trading, I could not afford a mentorship. So guess what? I literally had to spend that time that I did not have to pay, I needed literally had to spend it learning. And now, as much as I learned, I still had to, back test, practice, evaluate, you know, back test my strategy, my knowledge base, and a whole lot of that. So yes, you need to join with FX mentorship. And if you are coming through my YouTube channel, I can guarantee you a 20% discount on our mentorship, our 3 months advanced VIP mentorship. And now here's the beautiful thing about it. The price is changing soon. So a time is coming, it will no longer be at that price. So in case you want to join, you should join now, because trust me, the price is not going to be the same. In short, I'm sure very, very soon, very, very soon, we're upping our prices and our performance and everything. So yes, you want to be on board so that the train does not leave you behind. Also, you want to keep practicing. Keep practicing, keep practicing, keep practicing. You did not learn how to ride a bike in one day. You did not learn how to ride a car in one day. You did not learn how to ride. You did not learn how to become a medical doctor in one day. Everything took process. Everything took time. Everything took patience, learning, unlearning, relearning. It was a never-ending process to get you to where you are currently. So in that light, you want to keep practicing. And trust me, if you can do that, you're gonna definitely make a head start compared to any other person that's looking to dive into the forex trading market. Now, the most important one, which I don't like to leave out, is network with other forex traders. Now, you're not networking because you don't know what you're doing. You're networking because iron sharpens iron. The more you see people, feel people, talk to people, touch people, engage with people that are doing the same thing in the same space, the more you get aware, the more you get enlightened, the more you get driven, the more you get constant, consistent, the more you get active in that same space. Because yeah, you're going to have people share opinions, you're going to have people share their challenges, you're going to have people talk about their obstacles, you're going to have people talk about the difficulties, so that you know that yes, these things are real, but yet they are overcomable. You have people that went from literally a no idea to actually a pro analyst and forex trader. Now all this information put together, I just want to give to the world as much as I can. So yes, I look forward to seeing the next set or the next batch of profitable forex traders whom I hope to work with, in order to yes, take them from their beginning forex trading journey to their advanced self. So thank you very much for watching this video. And yes, I have come to the end of this beginner crash course, forex for starters. This is actually a beginner crash course just to get your feet wet, not to teach you everything. But of course, if you want subsequent videos, subsequent knowledge, insights, tips, feel free to follow us at Wealth FX Trading Made Easy. Like and subscribe to our YouTube channel. Be sure to join us in our free Telegram channel, and also join the WhatsApp discussion group for questions, answers, and communication, and also to interact with other forex traders that are trying to do well as much as you do too. All right, thank you guys for staying to the end of this video. You are amazing. If you got to this point, then trust me, you're definitely going to be a forex trader. It's just only a matter of time and how. So I look forward to seeing you in my next video. I remain your host, Mr. Babs, and yeah, have a beautiful day. Bye.